Oil prices are facing an uphill struggle as bullish bets drop to an 18-year low. Money managers have grown less bullish on crude for 4 straight weeks, amid growing concerns that the oil market is barreling towards a supply surplus near the end of the year. Meanwhile, geopolitical uncertainties and the US-led trade war continue to ravage the outlook for energy consumption. Naveen Das is a senior oil analyst at Kepler. So Naveen, let's start with geopolitics first. President Trump hasn't made good on threats to tighten restrictions on Russia's oil exports. Are traders right to unwind bullish bets that Moscow supplies will be limited?
To an extent, yes. As you mentioned earlier, financial positioning on both Brent and WTI futures have been moving shorter in recent weeks, suggesting that flows are skewing slightly to the downside to unwind these bullish bets. The most recent data shows that net long bets for WTI crude are now at the lowest since 2007, and short-only bets are at a 20-month high. That suggests that hedge funds are turning more bearish there. Brent, on the other hand, has seen an increase in both long and short positions on the week. Nonetheless, President Trump continues to be quite phased, or not that phased with how the Russia-Ukraine war has progressed. He's quite frustrated with the lack of progress. And as such, I think there is still a little bit of geopolitical premium, both in WTI and Brent, for prices.
Meanwhile, Russian oil exports to India are set to rise in September despite secondary tariffs. Will there always be a buyer of Russian oil?
I believe, as always, price will be a solver for the market. For now, it does not seem that Russian oil will get disrupted. It seems like it will always find a home, even if it needs to discount further to do so. It seems like the general appetite from the West is not strong enough, really, to shut in these Russian barrels. Even the latest EU sanctions package, the Sanctions Package 18, has some loopholes or caveats that may allow Russian-derived oil products to enter the European Union. So therefore, the wider fear around the inflationary effect of removing these Russian barrels, I think, looms larger than the fact of wanting to completely shut out this Russian oil.
Glut fears are growing, yet US oil production hit a record high in June. Will President Trump continue to push for more pumping?
That's a great question. It does seem for now that the US, or the strategy from the Trump administration, is to continue US oil production, to really push that forward. Nonetheless, the US is really fighting natural field declines, and the price as well may start to push some marginal producers, push their break-evens, that is, especially if prices drop. At Kepler, we do see that oil production from the US should decline by around 200,000 barrels per day in 2026, that is year on year, especially after reaching a high of 13.5 million barrels per day in June. Therefore, there is this maybe a slight tug of war between the administration's intentions and how technically they could extract more oil going into next year.
Attention now is on the upcoming OPEC Plus meeting. Has the cartel reached the end of their output hikes?
It's difficult to say where their strategy lies, especially going into the next meeting. Nonetheless, the group has managed their first layer of supply unwinds very well throughout the summer. It's been in a period of accelerated supply hikes, and they're now in a position where all options are on the table for them, be it more hikes, a pause, or even cuts. Their attempt to stabilize the market will dictate that. For now, at Kepler, we do not anticipate any attempt to unwind the second layer of cuts, that's the 1.66 million barrels per day, just yet. And we believe that in the next meeting, they will take a pause, observe how supply and demand evolves, especially in the fourth quarter when we're entering a period of seasonal refinery maintenance as well. So a period of seasonally a little bit lower demand. So we do believe that going into the next meeting, they will pause before assessing their options.
So finally, Naveen, a recent Reuters poll forecasted that Brent will average around $67 per barrel in 2025. Does that match your estimates, and will prices continue to be pressured lower?
This does. Our view, especially on dated Brent for this year, is to average $67 per barrel as well, with the ICE Brent futures averaging around $1 lower than this value. We have seen more elevated prices maybe than expected earlier in the year. So as such, our view for the remainder of the year is lower. The expected oil oversupply, which we see at around 2.5 million barrels per day in the fourth quarter, will dictate this and cause prices to push lower. We do see prices dropping into the mid to high 50s by year end as well.
That was Naveen Das from Kepler. Don't forget, you can watch more videos on Reuters.com.